Alibaba stock has certainly seen better days as it continues its march downward. We'll see if there's a potential opportunity here, since a lot of big investors certainly would say so, and do an intrinsic value analysis using a discounted cash flow model. But before I do that, I have to emphasize that you should do your own research before investing in any stock. I'm not making a recommendation for your own portfolio, as I don't know what your risk tolerance is, I don't know what your assumptions are, and that's up for you to decide. Let it be known that I do own some Alibaba stock. All right, let's do this. Here is the US listed version of Alibaba stock, but for these specific shares, the ticker symbol BABA, they technically are shares of this overarching VIE structure. It's a variable interest entity, that's what that stands for, and I won't be going into great detail in this video about that, but do realize that there are some legal complications that bring with them their own sorts of risks because of ownership laws in China. So to get around that, like many other Chinese companies, Alibaba has done this method, and again, it brings with it its own sorts of risks that you should definitely look into and weigh based on your own risk tolerance. But for the purposes of this video, I'm going to be focusing on the fundamentals of the business. But anyways, I wasn't kidding that Alibaba stock has seen better days. It's down 54% over the last year, and just year to date, it's actually up 2.9%. 2021 was quite brutal, but it's been pretty volatile even in 2021, although it seems to be hovering around this $120 per share mark. That means the company in market cap terms is valued at $331 billion. Now, Alibaba really is more of a conglomerate. It has many different sub-businesses within it, and each of them have their own varying levels of complexity, and also many of them are actually quite small in the grand scheme of things. But at least as of now, e-commerce makes up the vast majority of the revenue, and then cloud computing is growing quite rapidly as well. Not that there aren't other potential growth vectors that could make larger segments of the company later on, but those are kind of the two bigger ones that make up the vast majority when you combine them. But really still the backbone of Alibaba remains e-commerce, not to say that that won't change in the future. Let's go ahead and take a look at the financials to see what we're working with here. And I always like to start with the balance sheet, mainly to look at what sort of debt load do they have compared to their cash. Right now, they have about $42 billion in cash combined with about $29 billion in short-term investments. When you add those together, it's something like $71 billion in cash and short-term investments. So a large chunk of money. And if we compare that to their debts, we'll go ahead down here to long-term debt. They have about $20 billion. They have $5 billion in leases or so, and they have about $10 billion in other non-current liabilities. So I guess you could call it about $35 billion in longer term debt, and compare that to their $42 billion in cash. They could pay off all of that longer term debt in one fell swoop if they wanted to, and that's without even tapping into their short-term investments. So they have a net cash balance when you look at cash minus long-term debt. But another thing I always like to look at on the balance sheet is shares outstanding to see if we're seeing quite a bit of dilution or not. And it looks like we have over the last 5 years. We've seen the share count increase a fair bit, not a whole lot in the grand scheme of things. We're looking at a little bit less than a 10% increase in the total shares outstanding over the last 5 years, which is still pretty significant, though not crazy dilution. It's not like we're seeing a quarter of the outstanding shares being issued in the last year or something like that. But in general, when you're seeing a ton of dilution with a company, what that means is that there are now more shares outstanding, so every individual share is now worth less than before because there are more slices of the same pie. Basically, each slice gets a little bit thinner. Whereas the opposite is true with something like share buybacks, where shares are taken out of circulation, so there are now less of them, so that each individual share now has a larger share of that business and its underlying profits. So it's always important to be at least aware of dilution. Hey guys, real quick, if you want to get some free stocks, be sure to check out the affiliate links in the description below to Webull and Robinhood. If you open up accounts there, you get some free stocks, I get some free stocks, so it's a win-win. So please go get it. It's free money.
It's free real estate.
So moving on over to their income statement, let's see what they're working with on the top line. And revenues have increased very rapidly and already are at pretty large levels. And from 2020 into 2021, we saw something like 50% revenue growth, just absolutely huge growth. And even into the last 12 months, we're still seeing more revenue growth. The company bringing in a little bit over $126 billion over the last 12 months. Their next earnings call is a little under a month from now, so it'll be interesting to see how much they can continue this growth trend. Now, their top line revenue growth has been pretty explosive, I would say, just given the already huge size of the company. It's not easy to grow 50% from a base of $72 billion in just 1 year. That is massive growth. And even if that growth rate comes down quite a bit, it's still very large growth. However, at the same time, you are seeing some gross margin compression as margins have come closer to 40%, whereas before they were in the mid 60s. So as the company has grown, and this is a common trend, especially with huge companies, it's very hard to keep your profit margin that high as you really scale things out and try to grow new businesses. It just is very hard to keep that kind of advantage. You have more competitors potentially coming against you. So then it might become a race to the bottom with prices. And that's just the nature of business in a competitive world. But either way, revenue growth has been outstanding. So even if margins do compress a bit, if the revenue keeps growing at the same rate, it's really not that big of a deal. However, I don't think anyone believes that they're going to be growing top line revenues at 52% indefinitely. But what about cash flows? Anyone can grow revenues if they blow out expenses at the same time. So let's see what's going on there. Go to the cash flow statement. And I like to look at free cash flow, which is the cash from operations minus capital expenditures, the money that the business would be reinvesting back in itself, often for growth. However, we can see that they've been growing free cash flows quite rapidly. We're looking at something like $30 billion as of March 31st, 2021. So that looks at the previous year. And if we go down here to the trailing 12 months, we're looking at actually a decline down to about $24 billion in free cash flow, but still a very large number. But in general, the trend still is up, even if it might be a decline from last year compared to a few years ago, it's still significantly higher cash flow. But this begs the question, how much can they grow these cash flows? What can an already large company like Alibaba do to continue to keep that massive growth rate up? Are they going to be able to do that at all? So let's take a look at that. First, let's take a look at what their kind of business split is between all the different segments. I mentioned at the beginning that e-commerce and cloud computing together make up the vast majority, really. E-commerce in general makes up the vast majority. We're looking at about 66% of their revenues coming from e-commerce. And that's just within China. When we add on international commerce, we're getting up more towards 3/4 of the business. Whereas cloud computing makes up around 8% of their current revenues as of 2021. Now, commerce is a lower margin business in general, so it'll be interesting to see how the split looks years from now. But anyways, I do want to know what sort of growth in e-commerce we could expect from Alibaba in the future. Found this projection that looks at the whole Chinese e-commerce market, so not just Alibaba, and they're projecting something like, what is that? Almost 25% growth over the next few years up to 2024. So maybe we could expect e-commerce sales to grow by about 1/4. And if Alibaba maintains their existing market share as the pie gets bigger, they could expect to grow at about the size of the market. But that's assuming, again, they don't get any greater market share or that some other company doesn't come in and take more of their existing market share. But in general, if these projections are to be believed, it looks like the pie is still growing pretty quickly. But many people believe that the real catalyst for growth for Alibaba moving forward is Alibaba Cloud and their cloud services segment of the business, which when you take a look here at the rapid growth of the Alibaba Cloud revenues over the last few years, seems to make some sense that they could get some serious growth out of this still, since it's still currently only at $9 billion, still a large business, but it's almost been doubling every single year for the past few years. And if they can do that one or two more times, that's a massive segment of the business. And if we compare them to some of the global cloud providers, they currently have about 6% of the market, at least as of the end of 2021. But at least for the Chinese market, as it continues to develop, it seems like there might be quite a bit of untapped potential there for Alibaba and Tencent for that matter to continue growing, or even another player entering the space. And here's a quick look at the Chinese cloud market in particular. That last graph was worldwide, but we can see that Alibaba currently has about 40% of the cloud market in China. And that's actually pretty consistent to how Amazon Web Services is in the US. It has around 1/3 of the market. In this case, Alibaba has a bit over 1/3 of the market in China. Tencent, which I mentioned earlier, has about 16%. And there are some other competitors, of course. But if this overall pie can continue to grow rapidly, this is going to be a major engine for growth for Alibaba and really any of these companies involved. So those are some of the avenues for growth for Alibaba, but what about the risks? This is a Chinese stock after all, and that's been quite controversial, at least in the US investing market. There's a lot of tension between the US and China. People are nervous about the VIE structure I mentioned earlier, and there are definitely lots of things to be concerned about when investing in Chinese stocks. But even internally within China, there are some pretty significant risks. Alibaba is a huge company, so as with any huge company in pretty much any market, it has a target on its back. Though according to CNBC, economists say the worst of China's regulatory crackdown is over. Okay, sure, we're trying to tell the future, but I guess that's the whole investing game. We're trying to figure out what's going to happen in the future with only past information. But the fact remains that the Chinese government is very powerful and it can make some pretty dramatic moves very quickly that could really hurt a large segment of Alibaba or any business in China for that matter. And that is something to at least keep in mind. But how much you weigh the vague sort of concern of regulatory risk really is up to you. It's something that I'm definitely concerned with and is a big reason why Alibaba doesn't make up a much larger portion of my portfolio. But maybe that's because I just don't understand it as much, but it's a different environment and there are different concerns to pay attention to. And one other thing that does have me at least a little bit worried about pretty much any Chinese stock, but this is just me personally, is the fact that we've seen in very recent history some pretty nasty accounting fraud issues. And that's partly because the accounting standards in China are quite a bit different than here in the US, even though many of the big US firms do have Chinese subsidiaries that do auditing work in China, it's not as though it's all the same standards that you might be used to here in the US. So that is something to keep in mind and is something that has me at least a little bit worried, and perhaps it's an unreasonable concern, but it is a concern I have nonetheless. But if you're confident in the numbers and you believe they're trustworthy, then this obviously isn't that big of a concern for you. But I thought I'd at least flag it here. Let's go ahead and start crunching some numbers. This is a discounted cash flow model for Alibaba, and going through all the factors here, we have the growth rate for the first 5 years, growth rate for the next 5 years, so it's a 10-year analysis. I'm using a discount rate of 15%, which means that if everything here were correct and everything was priced according to this model, I'd be expecting a 15% return per year. I'm using a terminal value for the business of 10, which multiplies the year 10 cash flows by 10, and that gets you sort of the overarching value of the business, in addition to all the cash flows that will be adding up. I'm using a year 0 free cash flow of 25. Actually, I should make this 24 because that's the last 12 months free cash flow. This could change, I suppose, with the upcoming earnings, but we'll just use this as a starting point. And then I have their excess capital, which takes their cash and short-term investments minus their long-term debt, which brought me to $30 billion. So we start with our year 0 cash flow. We multiply that by the applicable growth rate in every single year. We then discount those cash flows based on our discount rate for each year. Then we take our year 10 cash flow and multiply that by the terminal multiple of 10, and that gets us a terminal value of about $677 billion. We discount that as well. We add up all of those discounted cash flows and the discounted terminal value and gets us a present value of future cash flows of $384 billion. We then add on the excess capital that they're working with now, and that gets us an intrinsic value of $414 billion or so. And with a current market cap of $331 billion, that would imply a margin of safety of 25%, assuming you use these growth rates up here, 15% and 7% for the first and second 5 years respectively. But how reasonable are these growth assumptions? That's obviously the big question for pretty much any investor. It's trying to figure out what a reasonable assumption is for the future. Well, if we work backwards here, we can take a look at the year 10 cash flow, which is currently at just under $68 billion per year. And that's less than what Apple's currently throwing off. Apple throws off something like $100 billion in free cash flow, and that's with today's numbers. So could Alibaba get to $68 billion 10 years from now if you think it's as great of a company or could be as great of a company of something like an Apple? Then maybe you think this is a reasonable assumption, or maybe you think this is too conservative, so you jack it up to 25% per year. After all, they have been growing very rapidly over the last few years, already a pretty big company, but let's see if they keep that up for the next 5 years, growing at 25% before slowing down to 7% in the next 5 years. Then your year 10 cash flows are at $100 billion per year, which is about a 4x from today's numbers. So could Alibaba 4x their cash flows over the next 10 years? Maybe. That's, again, up for you to decide. But maybe you think they flatline and just don't grow at all for the next 10 years. Then all of a sudden it doesn't look like a great deal, or maybe you're just very bearish on China in general. That's obviously a concern. And do keep in mind, I'm using a multiple of 10 here. And I'm using a lower multiple than I normally would because I'm trying to add a little bit more conservatism in this. Maybe that's because of tensions between the US and China, and maybe they just won't have quite as liquid of markets. And I'm not saying that's actually going to happen. That's really just another way to sort of add a margin of safety within your assumptions, because again, there's always a chance that all of this could be completely false and everything goes wrong. And the more conservative your assumptions, well, the more that has to go wrong for your investment decision to actually be bad. And on the flip side, the more conservative you are, the less you need to go right for things to actually pan out. So if I go ahead and put these back to 15 and 7% for the first and second 5 years respectively, and Alibaba looks like a pretty good deal if you believe these numbers are reasonable. And also because there are a lot of investors that I respect that have gone into Alibaba recently, so it's a sort of confirmation bias, shameless cloning, if you will. That's really what Alibaba was at the beginning for me. It was more of a clone of some of the bigger investors that went into it. Whether you invest in Alibaba is totally up to you. But in any event, if you need help with your finances, then definitely hire a licensed financial professional. I am not one of those. But if you like this video, definitely like it, since I would help the channel out a lot. And if you want to see more content as it has to do with investing and personal finance, then definitely subscribe, since I put out new videos every single week. And check out the free stuff in the affiliate links in the description below. But until next time, take care.